Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Mike Vinokur, Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth, will be joining us this hour. And in 30 minutes, we'll be discussing sustainable investing with Fate Sakhir, Senior Vice President and Head of Sustainability Marketing and Client Experience at Mackenzie Investments. And also, of course, we want to hear from you this morning on First Call. Reach out with your questions on North American large and mid caps, and we'll have Mike answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump has signed a permit for a new cross-border oil pipeline, reviving elements of the canceled Keystone XL pipeline project. The Bridger pipeline will transport Canadian crude into Wyoming and clears a key regulatory hurdle. The move comes amid ongoing trade tensions between Canada and the U.S., with officials saying it supports North American energy security. Air Canada has suspended its full-year outlook, citing a surge in jet fuel prices linked to the Iran war. The company says the spike is creating a significant shock for the industry and testing travel demand. Air Canada added it will try to offset some of the cost pressures while also adjusting its route network. Air Canada reported its latest results yesterday after the bell. Revenue and adjusted earnings both came in above estimates. Shares of Apple are up in the pre-market after its revenue forecast for the third quarter came in above expectations. This comes even as the tech company warns that memory chip costs will increase and that shortages of Mac computers will persist for several months. The outlook bodes well for incoming Chief Executive Officer John Turnus, who takes the reins from Tim Cook on September 1st. And now our top line story. As we've mentioned, Air Canada has suspended its full year 2026 forecast because of the sharp swings in jet fuel prices, and that is creating uncertainty. The airline says higher fuel costs linked to tensions in the Middle East are pressuring the industry, even as demand shows signs of strain. Still, Air Canada reported a strong first quarter with earnings and revenue beating expectations as fuel hedging helped lift profits. Let's digest all of this with our guest for the hour, Mike Vinokur, Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth. Mike, thanks as always for joining us on a Friday.
A pleasure to be here.
I think everybody welcomes a Friday sometimes. It's
Absolutely.
Not a bad thing. Air Canada welcoming a Friday. Your thoughts on the numbers?
Well, the travel industry has been quite strong for the last 3 years, and we are not surprised given the percentage of population that is past the age of 65. And normally that cohort, they love their travel. Mm-hmm. They want to see the world. They have the money. They have the retirement pensions, for example. And prices have been going up, and they're still buying. So we're not surprised by this. But yeah,
but even with everything going on, though, too, there's still the travel is still there, right?
Well, Europe, Japan, the Far East. I mean, these are places that people have probably waited their whole lives to see.
Yep.
The world has become a small place with, these sleeping pods and all these luxury things that one can buy now. And people are spending, and we're seeing it.
All right. And how much of a factor then is the suspending the financial guidance, the full financial guidance for 2026?
I think they're just being cautious because while fuel is a component, these new airliners are fairly fuel efficient. Mm-hmm. So we think that you're going to have to see a prolonged price hike in the $120, $150 range for it to really start to bite. We think that, it's going to hurt them, but they're going to have fuel surcharges kick into Q2, Q3 most likely, mm-hmm. and they're going to be able to make up the revenue.
All right. And I just going to digress for a second. With oil, it's up again, but it's not, and hasn't gone crazy. And a lot of people were fearing that. Have people adjusted, or is it we're not seeing the impact? We're seeing the prices necessarily, but not the impact of the shortages.
So it's interesting because there's a financialized oil market and then there's a physical oil market. And what we're hearing from news reports is that the physical oil market is actually trading at a much higher price than what you see on your screen. And so people see WTI today at 104 and Brent at, I don't know, 115, 116, somewhere in there. But I'm reading reports that the actual cost that physical crude is trading for is in the 140, 150 range, depending on which port of delivery you're talking about. So some customers are actually paying a lot higher than what we think. And perhaps here in North America, it hasn't hit us full bore yet, but that may come.
And we're going to talk more about that coming up in just a bit. But let's talk some more of the earnings. Magna International. Their earnings coming out. For the most part, slight cut in what they see for sales for the year.
Yeah, and you're seeing a lot of dealers now, I'm seeing anyway, offering better financing options, so maybe we're seeing a bit of a slowdown. There was this huge catch-up after COVID, everybody wanted a car, there wasn't enough supply. I think the market is still reasonably robust, and in fact, what we're thinking is that, pickup truck sales are probably going to be very robust.
They were doing well, right?
Yeah, and you know why? Because we think that a big proportion of people that buy the pickup trucks are people that are making a lot of money now, people in the energy patch.
So they're buying a second one.
You got it. Well, I don't know if they're buying the second one, but maybe they're upgrading, or they're renewing the fleets. That industry and everybody associated with chemicals and production, they're really going gangbusters, right? So maybe that's transcending into higher value-added sales. Magna reduced their sales by a tiny bit. And we think this has more to do maybe with delays in parts and things like that than it has to do with actual demand.
But nothing to worry about.
Not really, no.
All right. TC Energy also coming in. We're pulling them all out right now. There's so much going on. First quarter results.
Yeah,
we're literally getting. I'm just taking a look at them. Anything standing out to you on those?
Not really. It's a pipeline. It's a steady eddy business. There's always, that increase in return on equity that they get from the regulators, throughput increases. There's always typically demand going up, and they're a toll business, right?
Yeah, and they just announced another expansion, $1.5 billion natural gas expansion into the U.S.
Yeah, which if that gets approved, that's going to be great for the producers and for the pipelines.
All right, and the big one, Apple.
Yeah, full disclosure, we own Apple. Apple is one of those brands that I think is so iconic. I remember seeing an interesting brand list where somebody came up with the top 100 brands in the world that if people saw the symbol, they would automatically recognize it, right? And Apple has been at the top of that list. There has been other companies that have dropped off. For example, I remember Nike was a number top 10, let's say.
People would probably still recognize it then.
They would recognize it, but I think the difference between Apple and Nike is Apple has built this ecosystem where once you're in it, it's kind of hard to extricate yourself out.
I was saying that yesterday because I have a Mac and I have an iPhone, and as much as it drives me nuts because it doesn't interact with other things, but when it interacts with each other, it interacts really well.
Right. And so, maybe you replace your shoes with another brand. But my Apple, my whole family, other than my wife, is all on Apple. And we constantly do the upgrade.
Do you talk to her still?
Oh, yeah. She's actually considering switching to Apple so that the whole family unit's on one system. But yeah, no, listen, great quarter. These guys have shifted a lot of their revenues to services. Services is a much higher profit business. But the other thing that we're thinking about these days is what can AI disrupt? And it's very hard for AI to disrupt the hardware piece. The hardware IP, the actual iPhone, the Mac, all of these things that Apple makes, you can't
They're
really...
They're not going anywhere.
Unless
we get implants.
Right, but not in the short term is what I'm saying, right? So again, you've got a hardware-software combo with a brand, with a following, with an install base. So the stock is not cheap. Let's be very clear. It is not cheap. But it is a solid, stable cash flow business that keeps on investing, keeps on expanding, and keeps on innovating.
Any concerns about, they were talking about shortages because they're selling so many, which probably isn't a bad thing. and the chips cost going up in price.
Yeah, well, the whole industry is dealing with that, right? So you've got a memory chip issue, and then you've got a CPU, GPU issue. We'll talk later on about potentially second and third order effects of the Strait of Hormuz and how that may be impacting that industry. But I think, the whole industry is battling this, and they'll find a solution.
All right, I'm going to take a break on that note. And Mike was stealing my thunder there, because the throw is the fallout from the Strait of Hormuz shutdown is rippling far beyond oil, quietly reshaping global supply chains. We're going to talk about the impact beyond the price of oil. We'll have more on this after the break. Let's see how things are shaping up on the markets, and we'll start with the U.S. futures. It's kind of mixed right now, but you can see the Dow cracking 50. It's been a little while since we saw that. The NASDAQ hit a record high yesterday. The S&P 500 hit a record high yesterday. They all had magnificent months. I think the NASDAQ was up by 14%. Was it close? Mike, was it close? Mike's nodding his head. Somewhere around 14%. So quite the finish to April, one of the best since the pandemic. And heading over to Asia. And a little bit of a mix there. You can see the Nikkei up by 0.38, Hang Seng by 1.28 down, and CSI 300 about a wash for the day, heading into the weekend. Off to Europe. We're in the middle of the trading day there, and the FTSE is down slightly by 0.61%. CAC 40 up by 0.5%. And look at the DAX up by 1.4 right now. And the TSX yesterday, pushing that 34,000 mark again. Big day for it yesterday, up 1.94. Let's see who moved the needle for it. Taking a look at some of the winners. Yeah, Bombardier on their earnings. Look at that, up 20, almost 21%. Lithium America's up 15%. And then even the losers weren't that bad. Allied Properties off by 2.5%, and Alamos Gold by a little more than 3%. Taking a look at the metals, and gold is off by 0.68 right now, down below 4,600. Silver up and above 74, and copper pretty much a wash right now, sitting right around that $6 mark. Western Canadian Select from yesterday, it closed down 1%, maybe a bit of a different story today. Let's see where WTI is sitting at right now. Oh, it's off now again. The markets, you just never know. It's off by 1.6% right now at 103 a barrel for June. And of course, energy has grabbed the headlines, but second and third order effects from the closure of the Strait of Hormuz are hitting everything from helium to fertilizer, pushing food prices higher and putting pressures on some other industries as well. We're back with Mike Vinokur from Propellus Wealth Partners, IA Private Wealth, for his take on possible winners. Let's talk about winners in the supply disruption. All right. What are the secondary and tertiary? I mean, we all see the price of oil, and we see it at the gas pump. But what's some of the deeper fallout?
So in the last, I'd say 5 to 10 years, we've had refinery capacity move to the Middle East. We've had fertilizer production, helium production. I mean, before the closure, I had no idea that the Middle East supplied so much helium.
Huge supplier of helium.
Yeah, or fertilizer for that matter. You think fertilizer, you think potash, you think Canada.
Yeah.
Right? You think the Ukraine, you think Russia. I had no idea about the Middle East.
Don't think a lot of fields of...
Yeah, I don't think about agriculture and potash when I think the Middle East. I think energy, oil, gas, right? But yeah, they're a big... because of the natural gas, right?
Yeah.
And so now you're thinking, okay, farmers need fertilizer. What happens to food production? It's to our knowledge, it's not like grains where you can have grain storage, right? So if God forbid there's a bad growing season, grains sort of like the SPR, but for food, right? Yeah. I don't know that fertilizer is stored in the same way. So what happens when farmers can't get their nutrients? What happens when semiconductor fabs can't get the helium? Now, I know that there's a supply of helium, like a reserve, but that reserve is only for so long. So how do those helium supplies come back online? When do they come back online? How do you even transport helium? Is it easy? I'm not quite sure.
I mean, there is a joke in there. You think it'd be pretty light, actually, with
right.
helium. One would assume, but...
You would. So thinking through what impacts food production, what impacts semiconductor production. Semiconductors are in everything, circuit boards, it's not just computers, it's appliances, it's cars, it's everything, right? So how does that impact the economy? Now, on the flip side of that, this says to us that maybe people are going to start thinking, production in North America has cheap electricity, cheap energy, it's stable because it doesn't get disrupted. Maybe there's another reason to move production back to North and South America other than the Trump tariffs and that kind of thing.
Is this enough, though? Do you think this will be enough, what's going on?
Well, it's maybe another check mark.
Especially with LNG.
It's maybe another check mark because, now I'm hearing that Europe electricity prices are going to be much higher because of the natural gas prices. Well, if your electricity is so much higher, doesn't that mean your cost of production is so much higher? So if your currency, the euro, is high, and your cost of production is high, and your labor is high, well, are you still competitive?
Yeah.
And then what happens when you tell your customers, well, sorry, I can't get the inputs because there's no power, because there's no LNG, I can't produce? Well, maybe those customers will say, well, I need to think about where my source of supply is, right? Yeah. So it's not necessarily the end-all, be-all reason, but it may be just yet another reason to say, hey, we need to diversify in case in the future something like this happens and we want stability of that production.
It's almost the irony of the reverse of offshoring, right? We're inshore, we're the circle is we've come full circle, and we're going back to let's bring it back home.
Exactly.
But it's a big move, and it's a commitment, though, isn't it, for companies?
It's a huge commitment. So it's got to make sense, and hopefully, this thing gets resolved and people feel like it's a one and done. But, I remember the 80s, 90s, early 2000s, and every time you think we've resolved the Middle East, whatever that means,
something else comes up.
Something else flares up. And so I wonder if this one is the time when people rethink supply chains and really talk. Now I'm hearing that somebody's talking about building a pipeline through what is it, UAE? No. I'm saying in the Middle East.
Oh, in the Middle East
to bypass the Strait of Hormuz. Yeah. Now that's not going to be overnight.
No.
But I'm sure somebody's going to the drawing board.
I can see that with the Saudis because they've got that pipeline going to the
right. But what about the UAE? What about Kuwait? What about all these other producers that are saying, hey, what about me? Me too, right? And I didn't think about this. Good on you, Saudi Arabia. But now what do I do in case this happens again? All
right. We got lots more to talk about. And we will continue with Mike Vinokur to see why Cenovus is on his radar. Time to see what's on the radar from Mike Vinokur, Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth. And first one showing up is Cenovus. What are we liking there?
So Cenovus is a company that's got very long life reserves, as we know, through their oil sands. But they also have 4 refineries. And what's astonishing to us is that if you look at the crack spreads, which is really how refining margins are tracked.
And I saw today it was up again, right?
Yeah. So I looked historically, crack spreads have generally been $10, $15, $20. Between 10 and 20 has always been considered kind of a normal level. Right now, they're 50, even 55. Ooh. Now, I don't think that's historically the highest it's ever hit, but it's up there, right?
It's up there.
So you've got a company like Cenovus that just did a major acquisition of Meg Energy. Obviously, they didn't know what was coming down the pike. And so oil was $65 or whatever it was. Now, all of a sudden, they should be gushing cash flow. Maybe not this quarter, because this quarter the war broke out end of February, so maybe month of March they picked up a little bit of upside. But now for Q2, Q3, all the oil producers are most likely hedging out their production at much higher prices, and Cenovus has the added bonus of those very high refining margins. So that to us, we think this is going to be a huge cash gusher. And that's going to accelerate their returns to shareholders, which they've already been doing. They've upped their dividend, they've been buying back stock, they've been paying down debt. We think that accelerates.
And do they have capacity at these facilities, at the refineries?
Oh, yeah.
Yeah.
They've been turning them around. I believe they're mostly U.S. facilities, which they bought. I believe 2 or 3 of them had issues. So there were ebbs and flows. They had to turn them around. They had to shut them down. They made some investments. I believe now, to my knowledge, they are humming along and they are gushing cash for Cenovus.
Okay, let's get next one in there. Rogers Communications.
The whole telecom space has been beaten down for the last 2-3 years. I think since the summer of 23, if I'm not mistaken, maybe 24. It's been a hard slog. But we think that the equity prices have found stability. We like Rogers. The reason we like Rogers is a couple things. One, we think that the whole MLSE acquisition, in hindsight, was probably fortuitous. I'm hearing that they're going to pull some levers in order to accrete value to shareholders of Rogers through the MLSE banner. Okay, so that's one.
Okay.
2.
Have we heard how they're going to do that?
I don't think the plans are set in stone just yet, but I think that they're going to maybe bring in some investors, maybe monetize certain parts, which will give them excess cash to maybe pay down debt or do whatever.
What's it, 20? I've heard 21 billion for?
Something. Well, you know what? These sports teams' valuations are insane
it's
in general, right?
Bit of a crapshoot figuring it out, but I think that was one of the numbers
Yeah.
that's been bandied about for the whole package.
Right. So that's the first thing. The second thing is they just reported their quarter, and their quarter was pretty good. But what we were very interested in is the fact that they said they're going to be able to reduce their CapEx by a meaningful amount of money. Right. So now all of a sudden we were modeling 3.1, 3.2 billion of free cash flow. And my recollection is what they said is that's going to eclipse $4 billion now.
Okay.
Right? So you look at the valuation and you say, my God, if the $4 billion is sort of the new baseline, and maybe they grow it from there just a little bit, call it 3 to 5% a year.
Yep.
Well, now you've got a company trading at market cap of what, 25 billion, something like that, generating 4 billion of free cash and growing, which allows them to pay down the debt a lot quicker and maybe even buy back some stock.
But and the growing, is it strictly from the MLSE? Or
no, just general growth. I mean,
because isn't that the big concern with the comms right now? Is where do you grow?
Well, that's the thing, right? We think that population has moderated. Obviously, immigration going the other way, right? We've heard of the emigration, the brain drain, whatever you want to call it. But look, at some point, these numbers are going to ebb and flow. Canada is still seen as a pretty decent country to want to come to.
Yep.
And so we think that you're going to have a baseline stabilization, and then you're going to have potentially a very slow upflip. So let's say the population grows by 0.5%, 1%, right? So the numbers are not huge, but here's the kicker. What they also announced was they're offering early severance to half of their 25,000 employees. Now, we don't know what the uptake is going to be, but whatever the uptake is... I think it'll end up being a lot smaller than that, but it's... Well, but let's say it's 10%, let's say it's 20%. I don't know what the number is, but I surmise that those impacted employees, those are going to be permanent severances. In other words, they're not going to rehire people. They're somehow going to use technology and cost efficiencies to replace them, which means those cost cuts are going to be permanent. So maybe that even escalates the free cash flow going forward. We'll see. Okay.
We got 30 seconds for BLDR, Builders First Source.
Builders First Source is a much less known company. They have grown from nowhere to become the largest national supplier in the building home products business. It's been a terrible business for them because of cost escalations and because of lowering of demand. But we think that's the opportunity because we think margins are at trough levels and so are sales, and we're looking for the upswing in demand.
Okay, perfect. We'll wrap it up on that note there, Mike. Stick around, though. Lots ahead. including the U.S. president approving a project to carry Canadian crude to the U.S. We're looking at how sustainable investing can fit into the bigger picture with our next guest. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. U.S. President Donald Trump has signed a permit for a new cross-border oil pipeline, reviving elements of the canceled Keystone XL pipeline project. The Bridger pipeline will transport Canadian crude into Wyoming and clears a key regulatory hurdle. The move comes amid ongoing trade tensions between Canada and the U.S., with officials saying it supports North American energy security. Air Canada has suspended its full-year outlook, citing a surge in jet fuel prices linked to the war in Iran. The company says the spike is creating a significant shock for the industry and testing travel demand. Air Canada added it will try to offset some of the cost pressures while also adjusting its route network. Air Canada reported its latest results yesterday. After the bell, revenue and adjusted earnings both came in above estimates. Adjusted profit at Magna International rose compared to a year earlier. Sales for the quarter were also up, and both metrics topped analyst expectations. However, despite the positive sales and earnings, the automotive supplier is trimming its outlook signal, and that is signaling a more cautious view for 2026. Quick peek at the U.S. markets, and all in the green right now. And you can see those numbers are all hovering. Not quite, the Dow not quite into record territory, but the Nasdaq and the S&P 500, though, in and around the record highs set yesterday. The Dow over 50,000. A new project was approved yesterday to bring Canadian crude to the U.S. The deal is a revival of the Keystone pipeline, which drew concern from environmentalists. Joining us now to explore how sustainable investing may fit into these new deals and more is Fate Sagir, Senior Vice President and Head of Sustainability at Mackenzie Investments. Fate, thank you very much for joining us.
Thank you for having me.
Let's get your initial reaction to that, the new pipeline, the pipeline that was just approved south of the border, at least.
Yes, certainly lots of headlines on that this morning. So when we're looking at these types of projects, and certainly the Bridger pipeline expansion, we're really evaluating them through the lens of what we're calling now the energy trilemma. So balancing energy security, affordability, and sustainability. And there's certainly, especially today, a clear recognition of the role that infrastructure plays in supporting energy security and reliable supply, especially in North America and again today in today's environment. But at the same time, investors are going to be increasingly focused on Indigenous partnerships. That was a big deal in the original Keystone project, and environmental considerations. So, and they'll look at them not just from social factors, but really as a fundamental to the project's viability and timelines. I think regulatory certainty is also going to be critical, given the long-dated nature of these assets, and importantly, investors are going to be assessing how these projects will fit into the long-term energy transition. So, this just continues to reinforce that this transition is going to be about a capital allocation story where multiple priorities are going to have to be balanced.
Fate, can you tell us about the economics of the industry, given where the prices of competing fuel sources like natural gas are in North America, for example, and the recent input costs? Do the economics still make as much sense as they did perhaps 3-4 years ago when interest rates were zero or near zero?
Yeah, so I will preface by saying I'm not an expert on the commodity markets, but certainly what we're seeing today is, natural gas prices were not as competitive. We're still trying to figure out our trade agreement with the U.S. So that'll be really interesting to hear from, the Canadian government and see what their reactions are. It's a bit, just from my lens, it's a bit We've been talking a lot in Canada about exporting into Asian markets and finding new opportunities. So it'll be interesting to see how this all fits in, and we'll see what the impact is on commodity pricing.
And it must be challenging for the sustainable investing with stocks, especially energy stocks surging, and the markets going up. People want to chase the dollar sometimes. How are you striking that balance right now?
Yeah, so and we just completed our 7th annual Earth Day study, where what we found is actually a continued growing interest in sustainable investing, and what we're seeing there is there's a transition from this space being purely a values-focused space to more a fundamental space that's focused on the investment risks and opportunities. And one of the big findings for us, we did ask about the energy transition. It's certainly making a lot of headlines. It's a very important part of Canada's story. And what we're finding is Canadians are very interested in the transition. They're interested in and believe that the transition is going to be made up of renewables and fossil fuels. And so what that looks like and how we think about fossil fuels in terms of transitional sources of energy will be interesting. That's still TBD. But there continues to be a growing interest, and we're starting to think about it as a part of a full value chain, where we will still have a need for upstream sources as well as downstream sources, and certainly renewables will continue to play a big part of that as well. Especially as we see growing demand on electricity, renewables are gonna help to bridge and are bridging some of that growing demand.
Fate, have you found in most recent times that governments at all levels have been working better with the industry in order to escalate timelines in terms of getting, projects on the ground working faster? How do you find, the bureaucratic paperwork associated with getting projects online? Is it getting better? Is it worse? Or is it about the same in your view?
Yeah, well, again, TBD. There's lots of things we're seeing out there. Like certainly, Bill C-5 was meant to do that and help to accelerate some projects. I think it'll be interesting to see how what that acceleration means. It takes a very long, more than a decade sometimes to set up some of these projects. So we need to move faster as a country. The new announcement of a sovereign fund in Canada, that'll be interesting in terms of funding and attracting capital here. So we'll see. I do think that there's an appreciation in today's world and certainly in the geopolitical circumstances that we're all facing. There is an appreciation that we need to move fast. There's a focus on our economic prosperity as a country. And, when I think about sustainability and the way we've been viewing it, and it's certainly the definition is you've got economic prosperity, social inclusion, and environmental stewardship. So, you get sustainability when all these three dimensions are in balance. And, today it's going to be really hard to balance all three dimensions when we feel that, our sovereignty or our economic prosperity is at risk. So I think that's what we're seeing from this current government in Canada. They've certainly been really focused on establishing, Canada as a energy superpower. So more to come, but good progress, I think, so far.
And I just want to sneak in one more question, and we're supposed to wrap up here. But AI, where does it fit in when it comes to sustainable investing?
Yes. Well, it fits in to many, there's a lot of pros and cons with it. Sometimes I refer to it as we think about Maslow's hierarchy of needs and what is the priority for us. It really is, food, water, shelter, and AI is not helping with any of those. Now it will help to, with grid balancing and so on. There is going to be lots of benefit from AI. Right now, it's certainly driving the demand for electricity, and so and that's where a lot of when we're seeing renewable power come online, it's being supporting that growing demand from data centers. So pros and cons, we'll see where it lands. And for us, we're always looking at this from a very balanced approach. But, is it helping? Is it helping keep the lights on and keep us warm and so on? I'm not sure. So it is about the balance.
Okay, we have to leave it there, Fate, but thank you very much for joining us.
Thank you for your time.
Fate Saghir is Senior Vice President and Head of Sustainability at Mackenzie Investments. Still ahead, the next stress test for private credit may not be defaults, it's what happens when the loans come due. We'll discuss it after the break. And our phone lines, of course, are open. Mike Binnicker is taking your questions on North American large and mid-cap stocks. Call us at 1-855-326-6266. Email us firstcall@bellmedia.ca. In private credit, the bigger worry right now isn't credit quality. The key question is whether loans can be refinanced when they mature. Let's get more on this with Mike Binnicker, the portfolio manager and senior wealth partners at IA Private Wealth. Mike, it's one of those Fridays, Mike.
That's all right.
Okay, let's talk private credit. I'm just having one of those days. You're not super concerned about it.
So I think there's two distinguishing factors. There's the credit itself, and everybody's, worried up in arms about all these software loans that, were made through the private credit space. And are these software companies really worth what they were underwritten at? And that is a valid concern. But we think, across the private credit industry, it's a big number, but it's not, like 50% of it. It's maybe 10, 15% from what I'm hearing in different providers. And that, that's manageable. And I'm sure in that 10 or 15%, there's some wonderful companies out there that are going to get bought out, taken out, go public, whatever. Okay, so there will probably be defaults, as there always are in every credit cycle. The bigger concern is this. We're hearing it from clients and people we talk to. People went into private credit thinking, oh, this is great. I'm going to buy a fund and the net asset value isn't going to move too much and I'm going to get a nice coupon and it's going to be much better than what I could get in a GIC or a government bond or a corporate bond or whatever. Fine. But now I need money and I can't get out.
Yeah.
Okay. So if you're an institutional investor and you are good for the next 10, 15, 20, 30 years as part of your allocation, that's one thing. But when you're a retail investor and you didn't necessarily realize that you can get in, but sometimes getting it out,
you can't necessarily get out.
It's not so easy, and it may take a long time.
Yeah.
What happens when those loans come due to the underlying companies, right? Let's say the credit is still decent. Let's say the underwriting is okay. But can that company now go to somebody else and say, I need to refinance the loan that Mike and Roger gave me because they want their money back?
Yeah.
And they say, nobody else wants to give us the loan, and we don't have the money to pay you back the full face value. So what does the lender do? The lender has to extend. Are you going to put the company into default and then take over the company? Like that doesn't necessarily work either. So it sort of reminds us of the pretend and extend days of the great financial crisis when, a lot of banks said, okay, we're going to pay, or even COVID, right? People couldn't pay their mortgages. And the bank was like, okay, we'll issue forbearance, right? But so what happens then? And so that's going to be a big question in our minds because the private credit industry has grown by leaps and bounds, and it's sopped up a lot of money. And we're not saying that private credit is good, bad, or otherwise.
Yeah.
We're just saying
these are things you need to be aware of.
You got to understand the dynamics of private credit, how private credit works, where the liquidity valves are, and be very comfortable with that. Otherwise, it may not be for you.
Do we have an idea of the number of loans that are coming due this year, or is there any way of tracking any of that?
I'm sure there is. I don't have numbers off the top of my head for you, but here's the thing that is in the back of my mind. In 2020, 2021, we had a boom in markets, right? everybody, it was COVID.
Yeah.
Governments were pumping money.
Banks
M2
were low,
money supply,
rates were low.
Rates were low. And so I have a surmising feeling that because rates were so low, people said, well, I can't make 1% on my money or 0.5.
Yeah.
I'm going to try and make 6, 7, whatever in maybe this thing called private credit. So we surmised that a lot of money, because rates were low and because everything was exciting, right? Companies raised a lot of money. And usually the tenors of those loans are 3, 5, 7 years. So you got to believe that there's a lot of maturity, credit seasoning in the portfolio happening, and a lot of maturities happening in like now.
The next little while,
right? And so the interesting part is going to be the credit dynamics of, do we pretend and extend? Are we going to get more maturities back? Are these companies going to be able to find would-be lenders from banks or other private equity capital or whatever? At the margin, how's this all going to play out? So we'll see.
And do you think it'll be a mix of that, or could it end up being just a kind of a tidal wave towards one direction of those?
No,
those
it's probably
options?
going to be a mix. It's probably going to be a mix. But the thing is, it's always the question is at the margin. What percentage of either the lenders or the borrowers get hurt? And how does that domino effect affect either the credit markets in general or any other adjacent industries?
All right.
And that's what we'll have to see.
Okay, we'll leave it on that note there. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a bullish call on Celestica. Let's take a look at some of the notable analyst calls and recommendations. Rothschild Redburn initiated coverage of Celestica with a buy rating and a price target of 460 US, citing the company's growing exposure to AI infrastructure. The firm says Celestica is well positioned to benefit from rising demand for AI-driven data center hardware, with improving margins and a stronger growth outlook as hyperscalers ramp up spending. Morgan Stanley upgrading Caterpillar from underweight to equal, pointing to stronger than expected results and improving fundamentals. The bank says recent earnings performance supports a more balanced risk-reward outlook, even as it remains cautious on the broader industrial cycle. Morgan Stanley also boosted its price target to 915 US from 430, signaling more confidence that Caterpillar can hold up better than peers if global demand stays resilient. All right, when we come back, Mike Vinokur takes your questions on First Call. All right, time for First Call, and that first caller is Daniel from Markham, Ontario. Daniel.
Hi, Roger. Hi, Mike. My question is on Suncor. Do you see opportunity or a pullback for an entry point to buy it, and at what price? Thanks for taking my call.
Oh, thanks for the call. So full disclosure, we owned, it's Russell Metals, right? Is the caller?
Suncor.
Oh, Suncor. I'm sorry. Suncor. So Suncor, two things. One, wonderful company, great execution, long life assets, refining margins. I talked about Cenovus. We don't own Suncor. We do own Cenovus, but it's the same kind of thing. The difference is Suncor also has the retail channel that Cenovus does not. So the one thing I would tell you is this. We are sort of at the tail end of the period of seasonal strength for oil and gas. Normally, that period of seasonal strength runs from December to May. And today is the 1st of May. And, typically you've got a softening and then maybe a rebound towards the end of the summer into September. Now, this year is very different, given the closure of the Strait of Hormuz, given the backup and all the barrels we've already lost. So I think if you're a long-term investor on any pullback, you can probably buy Suncor, collect the dividend, and wait for the growth. However, I'm going to make one cautionary tale here.
One caveat.
If the Strait of Hormuz is opened and there's a restart a lot faster than people think, you're probably going to see a violent correction in the price of oil. And it could go down $20, $30, $40. It may not stay there, but you have to be prepared for also a violent correction on the stock price.
All right, let's get to, we're going to get to Daniel, get another call in here. Sorry, not Daniel, Gerald from Montreal.
Good morning. Thanks for taking my call. How about Russell Steel? What's your opinion on that?
All right, thank you, Joe.
Oh, thanks you. So full disclosure, we did own Russell Metals, and we recently sold it just a couple percentage points below where it's trading at today. Wonderful company, great acquisition, great capital stewardship. We like the fact that they operate both in Canada and the U.S. For us, it had nothing to do with the company per se. It was strictly a valuation call. But you could probably hold it, collect the dividend, and as long as the booming construction industry keeps on going, Russell Metals will probably increase their profits and continue chugging along.
Okay. Mike, we've got to wrap it up there, but thank you, sir, as always, for joining us.
Thanks
Have
for
yourself a
having
great
me.
weekend. And that was Mike Vinokur, Portfolio Manager and Senior Wealth Advisor at Propellis Wealth Partners, IA Private Wealth, joining us. And Lindsay is up next with the Open. Trading gets underway in just over 30 minutes from now. Have yourself a great day and a great weekend.